Welcome to Inside Economics. I'm Mark Sandy, the chief economist of Moody's Analytics, and I'm joined by my two trusty co-hosts, Marisa DiNatale and Cris. Hi, guys.
Hi, Mark. How have you been?
I've been traveling a lot. This is a
Yeah.
Saturday, a rare Saturday podcast. We generally podcast on a Friday, but I've been in Europe and I was on a plane most of yesterday from Rome to London. So thus we're talking today on a Saturdays, but it's good to be talking with you guys. Good to see you.
Very
Anything
good. So,
happening over there
Nice to see you.
on
so
the
I'm
other side
picturing
of
you in a cellar in Rome, glass of
the pond?
Chianti in
Drinking
your hand.
Chianti.
You know what? Now that you say that, Rome was really nice.
It
I'll have to
is.
tell you. I mean, I hadn't been in Rome for a number of years. I can't even remember when, but it's a beautiful city, and the weather was picture perfect. 70, 75 degrees, sunshine, really, really nice weather. And got to meet a lot of government officials and Bank of Italy, and
Oh, wow.
yeah,
Yeah.
it was pretty interesting couple of days. So I really enjoyed it. But now I've found my way to London. We have our conference in London next week. Going to meet a lot of clients in the next few days. So it's been a good couple of weeks, but tough time to be away from the U.S. given all the activity over there. What do
Yeah,
you
but
think?
you have an international perspective on the election.
I
What
do. I
what is
really
that
do.
like?
Of course, we're talking about the election, right? The U.S. election. That's what we're talking about.
That's what we're
Oh,
talking.
oh,
Yeah.
oh, yeah.
I think there's a fair amount of, I'd have to say, intrepidation over here. They're nervous about trade war, tariffs. They're worried about a lot of geopolitical issues. I mean, of course, what's going to
Yeah.
happen with Ukraine? Will that, and I think there's a general consensus that the Trump administration is going to uh, put pressure on Ukraine to come to terms with Russia quickly. And what does that mean? One positive perspective was, well, that might be near-term positive because the war is over, but then what does that mean for the longer run? Particularly if Putin is empowered by that move. They're worried about NATO. President Trump has talked skeptically of NATO and what the future there is. And that goes to their security. So they're quite nervous about that. And of course, some nervousness around the fact that they're probably going to have to ante up more for their own defense. Interestingly, they all feel like, well, we probably should do that. It's we agreed to 2% of GDP going to defense. So, but nonetheless, having to do that is going to be very difficult financially given their fiscal situation and given all the other demands that they have in terms of trying to improve their productivity and underlying growth rates. Mario Draghi, the former head of the ECB and a former prime minister of Italy, and what else? There's he's been kind of a fixture in European matters since the financial crisis or even before. He came out with a study focused on why Europe is lagging the United States in terms of productivity growth, something we were talking about last week, and what to do about it. And what to do about it requires resources, requires cash. And so if more of it's going to defense, that means less for, whatever else that can be done to improve productivity. So I'd say a fair amount of hand wringing over here, about that.
Were they surprised by the result, do you think?
Yeah, not so much that President Trump won, because that seemed like a real possibility.
Right.
Even in our scenarios, we attached an equal probability to him being president than with Harris. So that I don't think that was particularly a surprise, but the way he won with a pretty significant majority. I mean, he won the popular vote. By what? 5-6 million votes, I think. So, that's not inconsequential. So I think that was surprising. Were you surprised by that, Marisa? By the size of his victory?
Sort of. I mean, I was sort of bracing myself for the polls to be wrong, because they have been in the past. But yeah, ultimately, I was surprised that, he didn't win a single swing state, right? Like every single swing state, I think, uh, went to him. And so it was
Is that right?
that
I
was
kind of lost
surprising.
track. I stopped kind of paying attention when he, because Nevada, Arizona, did they
I
go?
guess, yeah, Nevada and Arizona, I believe, went to him.
Okay, so he got every swing
I
state.
kind of stopped paying attention too, but yeah, the
Yeah,
fact that he won every single swing state was surprising to
right,
me.
right.
Pennsylvania, Mark, you know,
I know.
Georgia, North Carolina, like the whole blue wall was down, right? So that was surprising to me. Not surprised that he won, but surprised that it was that
Yeah, that big.
widespread.
Yeah. Chris, what about you? Were you surprised by that?
Uh, not so surprised by, again, I guess with Mercer. Not so surprised that he won, but yeah,
Yeah,
that the margin of victory was so wide, right? The polls kind of threw us off there, right? Again.
right, right. Well, one reason that is being put forward for for what happened, for the size of his victory, is the so-called, if you want to put it into a phrase, the vibe session, that people just aren't feeling it. I mean, even all this happy talk from economists like us, like me. I mean, obviously the economy is performing very well, but that isn't resonating with many Americans, given the fact that they're paying a lot higher price for many things compared to a couple, 3 years ago. Rent and food and, to a lesser degree, gasoline. Um, do you think that that's what's going on here? Do you think that a big part of it, Chris?
I think so, certainly. That's at least what, again, well, if you trust the polls, people say that
Right.
that's certainly one of the criticisms. Um, yeah, I think that has a lot to do with it. And then I think a lot has to do with the messaging, right? I've been thinking about that a lot as well.
Hmm.
You know, if the situation was reversed and Trump had been given the card of economic indicators that we have today, how would the messaging have been different?
Hmm. Hmm.
Right? Well, he would have downplayed the inflation certainly, and upplayed all the other good things that are going on right in the economy. So I think that certainly is part of the reason why um, he was victorious. He was able to play his cards very well.
Yeah. Yeah. Marissa, vibe session, you think that's a big part of what happened?
Yeah,
Yeah.
I think it's more than just we get asked this. We've talked about this so much, right? Why do we think the economy is so good? I mean, we've said it's the best ever, maybe.
Yeah.
Um, but
In our lifetime.
the average person does not. And it's really it's everybody. I mean, every single demographic group, even the ones that went majority for Kamala Harris, leaned more right in this election than they had in 2020, right? So even the margins by which she won, every single demographic group, age, sex, race, income, um, were less for her than they were for Biden in 2020. So I don't even think it's like this TikTok thing we've talked about, right? Among young people, I think it's really everybody from all walks of life is feeling like they are being squeezed and they're upset about what they perceive to be still high inflation and high prices. And I 100% agree with Cris that I think the Democrats they keep doing it. They just keep falling down on the messaging in every election. And the Republicans are kicking their butt when it comes to how to message things.
Hmm. Hmm. It's interesting, this vibe session, it's definitely here in Europe. I mean, even abstracting from the election results, which, obviously made
Yeah.
people more nervous. In my visits, especially what I find, I'm learning from my visits with, here in Italy, and I mentioned, but I was also in Brussels, meeting with a lot of European Commission officials and give a presentation there. And uh, what I find most interesting, disconcerting, worrisome is that young people in their 30s, are really very nervous about things. I mean, to me, surprisingly nervous. I ran across this, I'm going to tell you who, Italian woman in her 30s. She was 39. I asked after I was a little, once I asked, I felt a little reticent about asking her, but she was very good about it because I was just very curious how old she was because of the conversation we were having. And she was saying that she wants to buy a car. Now I should say she's working a very professional job in a government institution that is backstops a lot of trade that Italian companies do, kind of like the XM Bank, in the United States. And she won't buy the car. She wants to buy the car. She's got it picked out. She told me the make and the model of the car, but she's not going to do it because she's in her words nervous that in she mentioned to me the flooding in Valencia as a reason because she has a home, it's close to a river, and she's afraid that same thing could happen to her that happened to the folks in Spain. I just found that so really fascinating. And it dovetailed with a conversation I had at the Bank of Italy because the folks there, and I'm not saying that anyone doesn't know that the saving rate in Italy and in Europe, I think more broadly, is on the rise. That it has started to rise, and to the point where their models aren't working. So they have a model that forecasts economic growth and consumer spending, and the amount of consumer spending they're getting is well below what they expect. The saving rate is rising. And the question is why, what's going on? And their theory was so-called precautionary saving, that this vibecession, these folks are very nervous. And if you got a lot of people like that 39-year-old who isn't going to buy that car, that's a problem. That's a problem. Actually, another interesting point in the context of the election and what may follow, becomes even more important in the context of a trade war, because if you have trade tariffs and trade war, and you can't get growth from external trade, which the Italians and the rest of Europeans do, it's a big driver of their economy. If they can't get that growth, then they've got to have domestic demand, kind of drive the train, but that's not happening. The saving rate is rising. So just really very fascinating. So other things she was worried about, because I kind of questioned her and what's going on. Of course, the Middle East, what's going on in the Middle East? Obviously, Ukraine and Russia, what's going on there? And now, of course, the election in the United States. So found that very, very fascinating. So yeah, it's this so-called vibe session it's really it's real. It's having real life implications, I think. It's a big deal. Okay. So Cris, the other thing that I found perplexing, we talked a little bit, maybe a little bit about it last week, was the what's going on in financial markets. In the post election period, in the last few days, we've seen a rally in stock prices. In what we talked about last week, an increase in bond yields. They've come back a little bit in the last day or two, but they're still up a lot from where they were a couple months ago. The dollar is up. Crypto prices are up. Credit spreads are down, narrow. That's the difference between yields on corporate bonds and treasury yields, which measures the kind of the risk in those bonds, the credit risk in those bonds. That's become thinner. So markets have really moved here in recent weeks and certainly since the election. What do you think's going on? How do you interpret all these moves in the financial markets? What are they saying about what investors are thinking is going to happen here?
Well, it's certainly all policy driven, our assumptions of policy. So tax rates, corporate tax rates likely to be cut to 15%. That's certainly positive for equities, right? Universally. So that kind of explains that rally. The assumption of increased deficits, additional spending, tax, even if we did nothing else but just extend the Tax Cut and Jobs Act, right? We're talking deficits. So there's going to be additional deficits. That's going to, require additional bond issuance. That explains the higher yields on bonds, right? I think in the short term, certainly all arrows point to growth, right? We're going to get this a little bit of a sugar rush, perhaps, with these tax cuts. So it's all positive, at least for this foreseeable future here. Even with, I mean, if tariffs come along, it's going to take some time for those to go into effect, right? The deportations also unlikely that that's maybe a day one decision, but in terms of actually seeing the effects of that on the economy, it's going to take some time. So I think that explains the rally mode that we're in. The crypto, I think, is a combination of a more favorable treatment of crypto, right? That's been promised that the government's going to open up or allow more activities, provide a little bit more, just enough regulatory guidance to give investors more confidence in that market, but not so much that it cripples it. At least that's the vibe I'm hearing. And then maybe you do have inflation investors looking at crypto as an inflation hedge potentially. So both of those factors might be driving that upward.
Right. Marisa, same interpretation of the market action we've seen?
Yeah, I think businesses are, I like your sugar rush analogy, Cris. I think, businesses are happy that tax rates likely coming down, regulations loosening or going away. That would explain the rally in the stock market. And yeah, I think everybody who's analyzed the plans of Trump and Harris have seen that under Trump's proposed policies that deficits and debt widen out. So it's probably likely a reaction to what his policy proposals look to be over the course of the next 4 years.
Yeah, I
And
think
bond yields.
when he talks about corporate tax cuts, going from a 21% rate to a 15, although it's not quite clear if that means all corporations or domestic companies or domestic manufacturers. I'm not sure, but I think the interpretation is kind of broader based corporate tax rates. That one for one is a lift to stock prices, right? Because that means after tax corporate profits, earnings are higher. I mean, the tax rate's lower, the amount of money that's going to the corporation, the shareholder rises. And if you just assume a constant price earnings multiple, price of stock divided by the earnings after tax earnings, you get a higher stock price by definition. It's just simple arithmetic. So that I think is a big part of the run up in stock prices. And of course, if you have more earnings and cash flow, that makes it much less likely you're going to default on a bond. Therefore, credit spreads come in, the corporate yield, bond yield comes in relative to the treasury yield. The other thing on the stock, in terms of the stock market, less regulation, right? I mean, in the financial services industry, banking, in telecommunications and technology, in healthcare, fossil fuels, if they're more lightly regulated, that means again more earnings and higher stock prices, and then probably I haven't heard this, but I think it might be also important, more mergers and acquisitions, right? I mean, I think the Biden administration was looked at M&A with the jaundiced eye. They were focused on market concentration and pricing. And I suspect that the Trump administration will be less suspicious of M&A activity, which then again is also positive for stocks. And then if you have tariffs and you have deportation, which means it disrupts labor markets that are already pretty tight in the construction trades and agriculture, manufacturing, transportation, distribution, retailing, leisure, hospitality, and of course, deficit finance tax cuts in a full employment economy, all that is inflationary. And I think we have seen inflation expectations pick up. If you go look at 5-year, break evens, which is a measure of, inflation expectations, they're up quite a bit in recent weeks. And also more, as you point out, deficits and debt. And so that explains higher bond yields. So that's how you get to the higher bond yields. So there might be an element of more growth there, but I suspect that's kind of, if I had to list, all the factors driving what we're observing in markets, that'd be closer to the bottom of the list at this point. But okay. Okay. Well, I understand we have a lot of listener questions that we've been collecting here over the past few weeks. You want to turn to those, Marisa? Do you have any good ones? And I think you
Yeah,
said there's a few of them that
a
are
lot.
kind of relevant to this conversation.
Yeah, there's quite a lot. I mean, there are two questions just sort of about this vibe session that you were talking about, right? Like, we have talked week after week about how good we think the economy is. We're economists. We're looking at broad metrics of the macro economy. We're looking at GDP growth and wage growth and the labor market, right? We're looking at everything. I mean, fundamentally, why do you think that that is, excuse me, not jiving with the way seemingly most of the country is looking at the economy? And is there something that we need to do better as economists to make people understand how the economy is doing? Or is it just, this is the way people feel about their own financial situation, and it is what it is?
Well, my sense is that when economists talk about the state of the current economy, uh, they're talking about growth, the GDP, jobs, they're talking about unemployment, they're talking about stock prices, housing values, and inflation, the rate of growth in the prices for goods and services as of this point in time. So, here we are at this point in time, all those things look good. The economy looks like it's on very solid ground. It doesn't account for the fact that we had very high inflation back not long ago, 2, 3 years ago, and that caused the price for many things that we buy, staples, groceries, rent, gasoline, are higher, much higher than they were 3 years ago. I mean, I think groceries are 20, 25% higher, even though the inflation for grocery inflation is moderated and is back close to, prices aren't really rising all that much. There's some items that are for very idiosyncratic reasons, like, egg prices are up a lot because of avian flu. But, if you look across all groceries, the prices for those things haven't risen all that much over the past year, but they are still up 20, 25% from where they were 3 years ago. So rent, the same thing. Rents are flat. They've gone nowhere. And on rents, probably not for a couple of years, but they're also up 20, 25% from where they were 3 years ago, 3, 4 years ago. Gasoline, that's less of an issue now, but still that's up as well. So, when people think about their financial situation and by extension the economy, they're still paying a lot for those items that they need, and their incomes in many cases on average have risen consistent with that, but just barely consistent with that. They're certainly not, we're not seeing wage gains that are higher than that, and that's on average. So that means half the population is experiencing wage gains that are less over this 3 year period that are less than, and I'm picking 3 years, roughly speaking, 3, 3.5, 4 years, something like that, during this period. Their wage gains have not kept pace with, the prices for these things. And so their kind of so-called real income, real purchasing power has been depressed. The other thing is, for many of the folks that are really upset, when inflation was high, they turned to credit cards and consumer finance loans and other debt vehicles to kind of supplement their income to maintain their purchasing power in the face of the high inflation. And it's one thing when rates were very, very low and they were borrowing back in 2021 and early 22, but now rates are very high. The average credit card rate, I think it's 23, 24%, which is just crazy high. I mean, can you imagine that? That's usurious. It feels usurious. It's a record high. And so you're paying a lot of interest on what you borrowed to help supplement your income just not too long ago, 2, 3, 4 years ago. And that's just made life even more difficult for you. And a lot of the folks that are, again, really, really upset, they don't own stocks. They haven't enjoyed the run up in stock values. In many cases, they don't even own their own home. I mean, 2/3 of Americans do, but 1/3 don't. And the 1/3 that don't, they haven't enjoyed the run up in house prices. And by the way, that means it's much less likely they'll ever be able to afford to buy a home if they want to. The potential first time home buyer has really been sidelined here. So that'd be my sense of it, that, that's what's going on. There's no game-changing event here that, will change that, the reality of that. It's something that will only change over time, assuming that the economy remains good, unemployment low, wage growth strong, inflation, as low as it is, people will steadily feel better, as we go forward. So, I don't know that there's anything that can change people's perceptions of that. I will say also, I think politics have played a role. I mean, if not for the election and everyone, you know, hitting each other over the head and making an issue, and spinning, the data and the reality of things, I think that has also played a role, because you can look at consumer sentiment. We've talked about this in the past. If you look at consumer sentiment surveys that, like the University of Michigan, if you're a Republican, you're feeling a lot worse about things than if you're a Democrat. So that just goes to the fact that, people's perceptions are colored by their political kind of perspective. It's much deeper and broader than that. Trump won, and he won by a good amount, so it's much deeper than that. But that, I feel confident, is part of the story, that the politics environment that we've been in has exacerbated the vibecession, this feeling that I'm being left behind. Cris, what do you think?
Yeah, I think that makes a lot of sense. I guess what I would add to that, what I've been thinking about, is just how people's perceptions of their own economy differ as well, right? So even if we just focus on households, individuals who actually have seen their incomes keep up with inflation or even exceed, right? Maybe slightly faster than inflation. Even those people are upset, right? They're feeling the pinch as well. I think there's a difference in how people view income growth, right? So they're seeing their incomes rise. I think people put that in the box as well. I earned that, right? That's because of my performance. That's a reward for what I've been doing and achieving. But that price increase that they're seeing, the inflationary increase that they're seeing, that's a tax. That's external to me, and that's not fair, right? That's being imposed on me. Whatever the source of that is, and then we can go into kind of some of the politics in terms of blaming certain individuals or situations, whatever. But I think at its core, I think that's part of the vibecession, is just in terms of how people view the different forces going on. So even if, again, real wages, real incomes might actually be improved, even if wealth is up, right? I feel I am wealthier, but still that price is really bothers me, because that's an external force. That's not the result of a good investment decision I made. That's the result of some other external force that's been imposed on me. So that's, I think, part of the issue as well. And now I'm thinking, and I kind of posed this to you in an email, Mark, is this an election kind of a referendum on the Fed's dual mandate as well? Should the Fed now, based on this, really be focused much more on price stability, lower inflation, and less on full employment, right? I'm not saying that it goes to zero. It's all about price stability. But maybe the weighting, which historically you could have said it was 50-50, both are important. Maybe it's not. Maybe they should be putting a little bit more emphasis on prices and more hawkish policy versus bearing in mind the full employment. I don't know. What do you think of that?
It's a very interesting thought, and definitely worth exploring. My instinct is we only feel that way now.
Yeah.
When unemployment's high, we're going to feel very differently about it. So I'm not so sure, I would change the weights. And once you change the weights, then it feels like we're going into recession. Think about if the weights were, 2/3, 1/3 in this last couple of years, we'd be in recession by now.
We would.
For no good reason.
But prices would be low. Prices would be low.
Yeah, but for no good reason. I don't know. I don't think that would land us in a good place. But but if you go to other parts of the world, I think most other parts of the world, developed world, central banks put a much higher weight on inflation. In fact, in many cases, like the European Central Bank it's all on inflation, right? They have one objective, and that's low inflation. Although that that's a good case in point. They made some pretty egregious errors because of that, right? Over the years,
That's right.
I
Yeah.
remember one episode when I was in Europe, and I think it was 2011 was it 2011? It was very clear. I think we were just coming out of the financial crisis, and they prematurely raised interest rates,
Hyped. Yeah.
and that may have been one of the causes of the European sovereign debt crisis that soon followed. It completely crushed their economy. It was like the most crazy thing to do. I remember being in Germany. The Germans really, they wanted this, right? Because they were at that time in
Yeah.
particular all about the single mandate, low and stable inflation, and they crushed their economy. And I think that's a good case study. If you want to change the weights, go take a look at what happened there. I'm not so sure that I would do that. But anyway, it's an interesting thought. I don't know, Marissa, you have any views on this? Why people are feeling the way they are?
Yeah, I think let's take the job market, right? The job market is, I think, objectively great. The unemployment rate is low. It's been low for years. We're not seeing massive layoffs. But for your average American, they don't really care what the unemployment rate is as long as they have a job, right? But with prices, that's something everybody faces every single day.
Good point.
And so whether GDP growth is 2.5 or 2%, or the unemployment rate is 4.1 or 4.5, that doesn't, who cares, right? To your day-to-day life, if you have a job and you're still getting a paycheck. But when you're out living your life and going to the grocery store and booking flights and hotel rooms and paying for daycare and going grocery shopping, that's something every single day that you face. And I just get a sense people are really angry, and there's a sense that it's not fair, right? There's a sense of this unfairness. I mean, even when I talk to sort of the people in my sphere, and they're constantly asking me about this, and these are well-educated people with good jobs who make good money. And there's this sense of like, I don't understand why I get what happened during the pandemic. I get the supply chain stuff. I get Russia, Ukraine. I get the spike in energy prices that resulted. I understand why goods prices were high. But why is it now when I go to a hotel, there's a list of 20 fees I have to pay, and to park my car overnight, it's now $75 a day. And it used to be 50. Like, what explains that? Is it just seems like corporate greed. It just seems like companies trying to just squeeze every little bit that they can. And it's this real palpable anger from people that I see all across the board when I talk to people. And that is something I mean, it gets me upset too, some of this stuff that I see, right? So
Yeah.
I just think this is like a universal part of the economy that everybody interacts with every second of the day. That's American consumerism that we all see. So all these other statistics about the economy don't matter to anybody except us on this call, right? Who are trying to make assessments of the broader economy. Your average person doesn't really care.
Yeah, no, that's a great point. I mean, I'm going to throw out one other thing, and I might not articulate this well, but it's exacerbating this kind of discomfort with regard to people's financial situation is just a general angst about everything that's going on in the world. That may be lots of reasons, because there's a lot of things going on in the world that are just not fun they're very disturbing to look at, but it's amplified by our media, by our social media. Like that, I go back to that 39-year-old Italian woman worried about the flooding in Valencia. Uh, you know, I pointed out to her that that kind of flooding probably happened 100 years ago, but you didn't even know about it because there was no way to know about it, right? So And even more, 100 years ago, no government's going to come to your rescue. I mean, I know the Spanish people are very upset that the Spanish government didn't come to the rescue more quickly, but they eventually came. 100 years ago, I'm pretty sure no one came. You're on your own. So and you didn't have insurance. Many people have insurance that can help them, kind of navigate through on the other side. But there's so if it's the same kinds of things that are happening over the years and the decades and the millennia, but you know about it firsthand and you know about it viscerally, you can see the pictures, you can see, kids that are or dogs or animals that are struggling. It affects you much more deeply, much more quickly. So I wonder if, we're just the vibe session and our angst around the economy is just, even more amplified by the fact that we've got all these things going on around us and they're in our face all the time.
It's feeding on each other.
It's
right?
feeding on, it's just reinforcing each other, all these interactions that are occurring that are just reinforcing these in our thinking about what's going on.
Let me ask you this, and this is sort of a corollary to this question. Do you think there's anything that, let's say, Vice President Harris's campaign should have done differently in terms of messaging around the economy and inflation?
Well, yeah, I think there was probably a couple things that were just kind of errors. Like, when VP Harris was asked, was there anything in the Biden administration that she could have done differently? And she said, no, I can't think of anything. That was a mistake, because there are things they should have done better and differently. And I think she could have handled something like that, that kind of a question, and turn that to her advantage as opposed to making that, something that, people said, well, really? You can't, if you can't, you don't think you did, if there's nothing you could have done differently, then you're not going to solve my problem going forward for sure,
Right.
So I think that's the case. What more substantively, pretty tough, right? Think about it. I mean, it's the Federal Reserve's job to get inflation back down, not fiscal policymakers. That's certainly not quickly. And there was things you can do, but they play out over long periods of time, like her housing plan to increase supply to help moderate house price and rent increases, which goes to the cost of housing, or her focus on prescription drug pricing. She did focus on food prices via gouging, and that might have turned some people off, but it goes back to your point that people feel like they're getting ripped off. So that actually resonated with people, a lot of people, because they felt like they're getting ripped off. But to answer your question, substantively, probably hard, pretty hard, not something you can solve very easily. Because you're talking about getting prices back down. You're not talking, you accomplish getting the rate of growth down, inflation is low and stable, but actually getting prices back down, I mean, yeah, that's a tough one. It's certainly in any reasonable period of time. Anyway, you want to pose another question? That was a really good one, consistent with the
Yeah, I'll just add one thing to that one, which is, sure, I agree there's not much that she could do in the capacity of the president to get prices down, but I don't know why they didn't go after Trump's policies being inflationary more. I mean, people are upset about inflation.
She was all about the national sales tax, the tariffs of the national sales tax. I mean,
Yeah, they
$4,000 per household if he got what he wanted.
They should have hammered that more. I
Really?
mean, I just think people are upset about inflation, but they just elected somebody whose policies are highly inflationary. And I don't think it's going to happen. We don't know, right? We don't know how the tariff thing is going to play out and over what time period. This isn't going to be like a day one thing. It may not even be 2025. It might be 2026, but putting a 10% tariff on every import, 60% tariffs on China, even if it's not that, tax cuts for very wealthy people, all of these things are inflationary. And she could have harped on that more, I think.
Yeah, I don't know. That's a tough one. I'm not sure. But you're absolutely right. I mean, it's fascinating. It's really, I think the word is ironic. I always have
Yeah.
hesitate to use that word because I'm not sure what it really means. But this feels ironic to me. This feels ironic. People voted her out because of inflation, the higher prices, and his policies
Hmm.
are inflationary. But to convince somebody of that, and that's the other thing I was reading that made this difficult. Uh, 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 I think it was Peter Coy in the Wall Street Journal wrote about economists are also big losers here because no one is paying any attention to us. We say this, but
Yeah.
you guys don't really, you don't know what you're talking about. So I don't know. I don't know.
Yeah, and we've actually gotten questions about that. Like, as
Yeah.
economists, what's our responsibility in terms
Yeah,
of getting
right.
this message out to people, and how do we more accurately explain things so people understand the difference between, year on year CPI growth and month on month, and what is inflation, and um do we have a responsibility in this sphere as well? Or do people even listen? I don't, other than the people listening to this podcast, you
I
know.
blame it on Cris. It's just Chris's fault. That's all I know.
I think
Somehow,
it comes
some way.
I think it comes down back to interpretation, right? I think a lot of voters, they don't expect that the tariffs are actually going to go
Right,
through, that
right,
this is a negotiating tactic,
right,
that
right.
President Xi is going to call up President Trump and they'll work it out. China will buy $2 trillion worth of goods and we won't actually go down the tariff path. I think that there's still that uncertainty,
I'm sure you're right. I'm sure you're
at
right.
least in the
But the more I
part of it.
read post-election, the more I'm confident that we're going down the tariff path and the deportation path.
I think we are. I think we
And
are.
pretty
But
soon, not 2026. This is a 2025 event, I think. Because he's ready, he's raring to go. President Trump's raring to go. And it just feels like this is going to happen. So
I do think the tariff thing is going to be a negotiation, though, probably over the course of several years, and they'll make changes to it, and other countries will relent and retaliate, and it's going to be this back and forth thing, I think. I mean, yeah, I think that he'll certainly start the process of all of this stuff on day one, and I don't know
yeah.
why people would think that he's not serious or he's just saying things. I mean, we saw in his first term in office, he tried to execute or did execute on pretty much everything that he said in one form or another. So I don't know why people wouldn't believe that he's going to do these things. I absolutely believe he's going to try. And now he has a Congress behind him, right? So it's going to be much easier to do a lot of these things than it was during his first term in office.
Yeah, I agree.
I think it's a question of degree, right?
Yeah.
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 Yeah,
It's not
exactly.
going to be
That's what I mean
20%
by
tariff.
negotiation.
Yeah. So
Yeah.
it'll be something though. It'll be higher than what it is today, certainly. But
Yeah.
Well, the other thing to consider is even if it's a negotiation, that creates a
a lot
economic
of,
consequence, right? Because that
yes.
creates a ton of uncertainty for businesses. Which products have a tariff? Which countries? Over what period of time? I mean, I was just looking at a list of products that have tariffs on them already. You look at this and you go, "Oh my gosh, this is like incredibly deep, complex. Very complex." So for a lot of these businesses trying to figure that out, they're just going to throw up their hands and say, I can't figure this out." And if you can't figure it out, you just stop. You stop investing. You stop improving supply chain resilience, which adds to lowers productivity and adds to cost and inflation. So there is a cost borne by the uncertainty created by what certainly will be a negotiation. You're right. There's going to be a negotiation, but if it takes a couple, 3 years, it's going to do that by itself is going to do some meaningful damage. Anyway,
Are you expecting a surge in imports over the next couple of
it's
quarters
happening. It's
as a
happening.
consequence? Yeah.
Have you seen the number of containers coming through LA
No.
long port? Oh
What's
yeah,
the
it's straight up. It's straight up. Actually, here's the other thing that's going to happen. I suspect, just listening to people, they're going to start buying things that they think might get a tariff. You go
Yep.
buy a washing. You better buy
I
that washing machine.
I've heard
With
that.
washing machines, I think there might actually be a spurt of spending
Yep.
here pretty soon because people are going to want to get in before the tariffs actually take effect. I'm
Yeah, I think it'll be
thinking
a good
about that.
retail sales holiday
Yeah,
season, right?
the holiday could be really gangbusters. Could really be gangbusters. Um, you want to take another question, Marisa, do you have another one?
I have lots. I have
Okay,
lots, and
let's just take questions. No game today. No game today. Let's
okay.
just play. Let's
All
just,
right.
'cause we're already close to an hour in. Let's take a few more questions.
Okay, so we kind of touched on this at the beginning of the conversation, but there's questions about, okay, now the Fed met this week. They decided to lower interest rates another
Oh
25
yeah, I
basis
forgot all
points.
about that.
Yeah, there was that.
There was that. Yes, right.
Right. So they met the day after the election. They lowered the target rate another 25 basis points. So now we're down 75 basis points from where we started. Why then, can you explain the relationship between the Fed's short-term moves and why we've actually seen 10-year Treasury yields rise? And we saw that before the election, right? So there is not this relationship, this tight relationship between what the Fed does and longer term interest rates, and certainly not mortgage rates. I mean, mortgage rates actually rose over the last few weeks. They're up around, I don't know what they were yesterday. They were like 6.9%, right? So
Yeah.
the Fed's lowering rates. We're not seeing that translate to mortgage rates or other long-term bond yields. So what's up with that? Can you explain the relationship there?
Chris, did I just see you grab some kind of animal? Is that what was?
Yes, my dog is very
Ah.
upset about the monetary policy.
Oh, cute doggy. Yeah. Oh,
Very concerned, I should say. So
very, very concerned. So Chris, did you hear the question? It's around what the Fed did lowering rates, but yet long-term interest rates have risen. The 10-year yield, Treasury yield is up. I was just looking at this earlier, 0.7, 0.75 percentage points, 70, 75 basis points since hitting a low back in early September. What's going on? How do you explain that?
yeah, I think it's a difference between the short term and long term. Short term, we're still on the right path, right, in terms of inflation coming in. We've continued to see pretty good reports. Rent growth is moderating, right? We could see things kind of moving in that right direction, but now there is concern about that longer run fiscal trajectory in particular. So I keep coming back to the deficits and the debt, but then also the tariffs, the other policies that could be inflationary, those would be longer term, and that therefore requires a higher yield in the 10-year and the longer term rates. Mortgage rates up substantially as well.
So
That's how
then you're saying this was kind of all being baked in even prior to the election.
I think the probabilities were certainly shifting in that
Yeah.
direction. Saw a really interesting chart in terms of what was it? The increase in the 10-year and so the expectations, if you will, and the betting markets, right?
Yeah,
Like
absolutely.
it was one for one, right? As the
Yeah.
probability of Trump winning went up, bond investors were taking that to heart and immediately pushing up the bond yield.
Yeah, I mean, I think the recent low in the 10-year was like 3.7, 3.65%. That was early September. That's when Harris was leading the most in the polls. That was the apex of her uh, popularity, and the betting markets thought that she had a chance to win. Since then, since that point in time, things changed dramatically, and by the time of the election, betting markets were saying Trump's going to win, and of course Trump did win, and 10-year yields are up now to 4.35%. That's that 70, 75 basis point increase. And in my mind, that goes to inflation expectations, right? I'm going to have tariffs, I'm going to have deportation, I'm going to have deficit finance tax cut and a full employment economy. That's inflation. So that adds to 10-year Treasury yields relative to what the Fed's doing. And then I'm also going to have more debt and bigger deficits in debt. And that adds to the so-called term premia. That's, again, goes to the difference between short and long-term interest rates. So in my mind, it's really about the election and the election results. That's why we've seen this disconnect between what the Fed is doing and what 10-year Treasury yields are doing. And of course, the 30-year fixed rate mortgage is tied to the 10-year Treasury yield plus a spread. And that spread also has widened, I think, a little bit here because the increased volatility in interest rates that we're observing in this environment, because there's a lot of uncertainty. Things are moving around quite a bit, and the market itself has got all kinds of structural issues. Broker dealers aren't expanding their balance sheets to be consistent with the growth in the amount of debt outstanding. So you see all this, you know, you know, 2, 3 decades ago, a 2, 3 basis point move in the 10-year yield was a big deal in a given day. Now it's moving 20, 30 basis points in an hour, and that adds to volatility. That volatility adds to the so-called prepayment risk. I'm not going to go down and explain that, but it's just jargon for fixed mortgage rates are going to be higher so because of the volatility in interest rates. So that's also goes right back to the election.
So Fed Governor Zandy, what do you do next month?
I keep cutting, because I've achieved my goals. I have 2 goals: full employment, check. I have a 4% unemployment rate, rock solid. And the other objective is low and stable inflation. The definition is a 2% inflation rate on a consumer expenditure deflator. I've achieved that, check. So therefore, the federal funds rate, the rate I control, should be consistent with its so-called equilibrium rate, that rate at which it's neither supporting or restraining growth. And I think there's appropriately widespread agreement that even with the cut in rates so far, it's still too high. 4.75 is still well above that equilibrium rate. So I keep cutting until I get to 4%-ish, and then I might slow, at that point. So that would be a December rate cut. We got one in November. We're gonna get another one in December, maybe in January. There's another meeting in January, and then in March, something like that. But once I get to 4, then I slow up, because there's a lot of uncertainty what that equilibrium rate is, and it could be as high as 4%. So then I take a look around and make decisions after that. That's what I would do.
Do you anticipate policies in the future?
I'm
so we get to
assuming I don't
February,
by January.
If we do see tariffs are destined to rise, do you
Yeah,
take
that gives
into
them a reason
account?
to slow down, right? I mean, I cut in December, I cut in January. That puts the funds rate at 4.25. Maybe in March, depending on what's going on with President Trump and fiscal policy. Maybe not. If tariffs are coming, deportations, I say, oh, I don't know what that implies for inflation. I'm going to slow up here. And by the way, they're also focused on inflation expectations. It's not just about inflation.
That's right.
It's inflation expectations, and they're up. So that would argue they should slow. They should slow up their rate cutting. So that would argue for them to to pause on their rate cutting to see exactly what the Trump administration has in mind, and let the dust settle before they start cutting rates again, I think.
Yeah.
What do you think?
I agree with you. I agree with you.
Yeah.
I think we're going to see a slower path. Certainly.
Fed Governor DiNatale, would you agree? Or
Yeah. And I don't know if you guys watched the press conference.
Oh, that was great.
Powell's press conference. And read the statement, and they were in the statement, they addressed the election. They basically said, we're not factoring this into our near-term policy decisions because we don't know what fiscal policy is going to look like. We're not in the business of speculating what's going to happen, and we're just focused on our dual mandate right now. And as far as we can see, the risks, between the labor market and inflation are balanced. So we're just going to keep marching ahead until we have more information. And then in the press conference, which was kind of funny, if you haven't watched it, you should go watch clips of it. Jay Powell was asked several times about whether if Donald Trump or someone in the administration asked him to resign, which has been floated around, right? His term doesn't end until the middle of 2026. And he just gave a very terse, no, I won't resign. And then the reporter said, can you elaborate on that? And he said, no. Yeah. And then there was a follow-up question. Do you think it's legal if they asked you to resign? And he said, no, it's not. It's not allowed under the law to basically mess with the FOMC before people's terms are up.
I have to tell you though, if President Trump, say March, April, says, I want the chair of the Federal Reserve to resign, I want to put my own person in there, I don't trust what he's doing. I know Jay Powell probably has the legal authority to say no, but would he actually say no? Would he actually say no?
Well, the irony is that Jay Powell was Donald Trump's pick for
Yeah,
the Fed
again,
chair.
irony. There's that word again. Yes. It's everywhere.
That is his person.
That is his person. Yeah. Yeah. Yeah, I saw that clip here in Europe. What I found even most amusing was the reporter was totally flummoxed.
Yeah, she
President
said,
asked you to resign.
you
Would
say
you?
more?
No. Can you
Can
say
you
something more
elaborate?
about
Elaborate
that,
on the-
please? No. I thought that was great. Good for him. Good for him.
But back to the 10-year
Yeah.
yield and long-term bond yield thing. I mean, basically, like the Fed is cutting. They've cut 75 basis points, but sort of almost gone nowhere because inflation expectations are up. Bond yields are up because of this expectation that Trump's policies will be inflationary and the debt to GDP ratio will expand over time. So the fact that they've cut 75 basis points almost hasn't really done much.
Yeah. The irony of the irony is that President Trump would be better off if Jay Powell doesn't leave, because if he left, then the 10-year yield would go
Gonna go,
skyward.
yeah.
The fixed mortgage rate would be 8%. So he's actually saving him by not leaving. Yeah. Great point. All right, let's take one more question.
How about some, this one is kind of near and dear to my heart. I don't really know the answer to it, but I think it's a good question.
Oh, okay.
My
favorite kind of question.
One that I don't know the answer to, or just.
Well, no, I'm assuming I don't know the answer either.
So this is around economic data integrity. So this listener said, thinking about the incoming administration, this is a bit of a biased question, I will say.
Yeah.
I'm wondering what kind of checks exist at our federal reporting agencies to publish accurate data. Is there a way to confirm that numbers, for example, in the jobs report are accurate and have not been tampered with? And I'll say that over the years, well, really since Donald Trump came on the scene, there's been these repeated accusations that the jobs report has been tampered with in some way by whatever Democratic administration is in office. I used to work at the Bureau of Labor Statistics. I used to write the employment situation report on a rotating basis with my colleagues and have some insight into this. But do either of you, and Cris, you worked in federal government too. I don't know if you were ever in an agency where you had to have security clearance to, well, sort of outside government, I guess.
Oh, Fannie, you mean?
Fannie Mae.
Yeah.
But that was a private institution when you were there, right? Were they
Yes, with a strong government influence. But
okay, fair enough. Yeah.
So I mean, I'm happy to talk about this having been in this, but what do you guys have anything to?
Well, my first reaction is, oh, geez, we're now questioning every single institution that we have, and we distrust every single institution we have. And that goes to the core of a well-functioning democracy. If you don't trust your institutions, if you don't trust the Bureau of Labor Statistics or the Federal Reserve or Consumer Financial Protection Bureau, whomever it is, you don't trust your government, democracy becomes more difficult it's just more fragile. It's not going to work. So I find that such a worrisome question, disturbing question. But I'll let you respond to, do you think the BLS or other government statistical agencies have been compromised in any way politically? Marisa.
I don't think. Yeah, I'll defend.
Go ahead.
I certainly have colleagues in these institutions. I've worked with folks. These are professionals with the highest degree of integrity, right? People who are generally trying to do the best job in terms of measurement. So I don't see this as a risk at all that someone would be compromised to fudge the numbers here. I am more concerned about the very real problems we've seen in terms of response rates, right? In terms of survey response rates and some of the data, right? I worried about that that response rate going down. So the numbers may be inaccurate because of, you know, the data collection process, but not because someone is putting their thumb on the scale. I see a difference, or what gives me some hope is that you know, we live in this very open society. We have a lot of other data sources now too that we can look at when we think about the labor market. We don't rely just on the BLS statistics, although they are still the gold standard. But we have other confirming data or other data that we can use to test, you know, whether or not the numbers coming out of the BLS are accurate or not, or reasonable or not. And we have private sources, other private sources. We have some other kind of state or local government sources. So we have a richness of data still that we can look to test whether or not someone actually is attempting to manipulate the data. So I'd be much more, again, I'm worried about the data collection. And then I would be worried about the narratives that get spun around the numbers, right? That's another issue. But the number itself, I think we have, again, high integrity individuals in these agencies who are, you know, they're just focused on doing the best job possible with the data that they have.
Can I say though, I do worry a little bit about it. I mean, do you remember President Trump in his first term front ran the BLS employment report? One report, he kind of said he put forward the number or gave people a sense of what the number was going to be before the number was actually released.
So that's a problem with the process. So yeah, certainly I'd be
Yeah.
worried about that, but I don't think he gave a false number, right?
No, I don't think so.
And I think
Yeah,
the number was
no,
accurate. He
no,
didn't
you're
follow the
right.
right protocols, right?
Yeah, yeah.
So
Which is
I will,
important though. I mean,
that's
that's
very
I
important,
don't
right?
remember that.
yeah, it goes to the
Yeah.
integrity of the process, doesn't it? I mean, if he's, I
Yeah,
mean,
yeah, it certainly. So that definitely, I would be
yeah,
concerned about some of those procedural things, whether he knew what the right procedure is and didn't follow it,
no,
or just
yeah.
was ignorant of it. I don't know. So I'd be concerned about that, but not. Again, I think there's this conspiracy theory has been put forward several times over the last decade in terms of folks actually within the BLS, you know, changing the numbers or.
Can I ask Marissa from your experience, is that even possible? Because there's like so many moving parts here, so many
Layers,
people
yeah.
involved.
There's so many people involved, and all of these people have a certain level of security clearance. So if you come in contact with a market moving economic statistic, you have to undergo a background check, right? Like you have to have a level of security clearance. And then the number, you know, the data are actually collected at the US Census Bureau, not by BLS, at least on the household survey side. So
Yeah.
if we're talking
Right.
about the unemployment rate, right? That's collected by the Census Bureau, the results of the current population survey. It's transmitted to BLS, where the data are then aggregated by a data team. And then it's sent to another group that then is responsible for creating the sort of employment report and writing up the description of what's going on, the narrative. There's people on both the payroll survey and the household survey offices involved. Only the people that need to know. So not everybody is aware of what the number is, only like the handful of people that are actually working on the report in these offices knows. Then at the sort of end of the week, it goes up to the BLS commissioner. They pour through every single word of the report in agonizing detail, you know, looking at it to make sure it's sort of just a descriptive narrative of what the numbers are. And then it gets transmitted to some key people in the government, like the Council of Economic Advisors, some people in Congress, and the president. It's hand delivered in a envelope. I mean, it's there's so many people involved at each individual step, right? That it would be almost impossible for somebody to come in and change this or manipulate it in any way. Just like every conspiracy theory, it would be too hard, and it would involve too many people to actually have any chance of working.
Yeah. Okay. Well, it makes me feel better. But that I found that's a really actually disconcerting question that we're thinking along those lines. So
Yeah, the
Oh,
fact
and
that
there
we even
was,
have to ask the
yeah,
question,
right,
yeah,
entertaining the question.
right.
there was a, last year, the BLS was talking about how Congress was going to cut funding
Yeah.
for the BLS and specifically for the current population survey, which is where the unemployment rate comes from. That did not happen. So the funding was put in place. And the result of that cut to funding was that they were going to cut the sample size of the CPS. So right now, the CPS is 60,000 households across the US. They were going to cut it to something like 50,000 households with reduced funding. It's as of now, budget that was passed this past year, they're not going to cut the
Well,
sample size of the CPS, but who
shouldn't
knows?
we be worried about that,
I
right?
think we should be.
Yes, I think just given sort of the narrative from this
Right.
administration about just sort of overall trying to shrink the size of government, drain the swamp, all of this stuff, right? Cutting the number of bureaucrats in government. Yeah, that's what I would be the most worried about is it, as Cris said, as just the integrity of the statistics declines because we're not funding these agencies that collect economic data. And think about how important that is. I mean, we wouldn't have jobs if we didn't have economic statistics coming out of the government. The Federal Reserve wouldn't be able to do its job. They have to look at all these data, right, in order to take a pulse of the economy and figure out what monetary policy is going to be. So it's very important. And I know I come from a statistical background, so I have a lot of strong thoughts on this. But I mean, that is my fear, is that funding will be cut for these agencies, the BEA and the BLS.
In the context of what Cris said, the falling response rate anyway. I mean,
Right.
and I think some central banks are already having trouble in other parts of the world. I think the British are having a real hard time with unemployment, their unemployment rate, right? They've had difficulty measuring it, and they've I think fixed the issues, but their response rates have been so low that they were for a while they couldn't measure the unemployment rate, I think. I hope I'm misstating that, but something along those lines. So it's already happening. So it's what we're saying is there might not be direct intention to mess with the data, but indirectly through the funding combined with all the other things that are going on anyway around response rates, it could mess up the data to a point where it
Yeah.
becomes a real issue. Yeah. Yeah. Okay. All right.
I think we'll be relying more and more on private sources anyway, right?
That's
We're
going to
already
happen anyway,
We're
right?
exploring those today,
Yeah, we're
right?
exploring those.
We have done.
Right. And actually, we have some really kind of interesting data sets
We do.
that are helpful in trying to understand what's going on. Not on the job side, though. I'd like to get more information there. But okay, I think we covered a lot of ground. I took a few listener questions. Didn't play the game, but I think we'll save that for next week. Anything else you want to bring up before we call it a podcast, Marisa, Cris? You guys are good?
Yeah.
Okay. I think we're going to call this a podcast, dear listener. I hope you enjoyed the conversation. We'll talk to you next week. Take care now.